If you think investing is only for rich people, finance majors, or people glued to stock charts all day, you've already been sold the biggest lie in money. Because the truth is, investing today is simpler and it's more accessible and more automated than at any other point in history. And once you understand a few core ideas, it stops being intimidating and starts becoming almost boring in the best way possible. Because boring is what actually makes people wealthy over time. Not flashy trades or lucky guesses, but consistent, repeatable actions that anyone can follow, even a small amount of money in limited time. So let's break this down in a way that actually makes sense and strips away all that noise that people feel stuck before they even begin. Starting with the most important shift you need to make, which is understanding that investing is not about getting rich quick, but about buying ownership in things that grow over time, whether that's companies, markets, or entire economies. And when you own a small piece of something that produces value, your money starts working for you instead of working for money, which is the entire game. And the reason most people never start is because they think they need a lot of money up front, when in reality, you can start with almost nothing. And thanks to fractional shares, low cost brokerages, and automated investing tools that didn't exist even a couple decades ago, meaning you can literally begin with 10 or $20 and still follow the same exact strategy as someone investing thousands, because the percentage growth is what matters, not the starting amount. And once you get that, the next thing to understand is that you don't need to pick individual stocks to succeed. In fact, most professionals they fail to beat the market consistently. So trying to outsmart it as a beginner is usually a losing strategy, which is why index funds exist and why they become the foundation of simple investing. Because an index fund is basically a basket of companies bundled together, allowing you to invest in an entire market with one purchase, which instantly reduces your risk compared to betting on a single company. And this is where things get almost too easy, because instead of researching hundreds of stocks, you can just buy something that tracks a major index and let the overall economy do the work over time. And historically, broad markets have trend upward despite crashes, recessions, and global events, which means patience becomes your biggest advantage. Not timing, it's not luck, just time in the market. And that leads to the concept that quietly does most of the heavy lifting, which is compound growth. Because when your investment earns returns, when those returns start earning returns themselves, creating a snowball effect that accelerates that, longer you stay invested. And this is why starting early matters more than starting big, because that time multiplies everything. And even small, consistent contributions can turn into significant amounts over years or decades. And this is where people underestimate what they're capable of, because they think investing requires large lump sums, when in reality, consistency beats size almost every time. So, setting up automatic contributions, even if it's just a small amount each week, removes the need for discipline because the system does it for you. And now, instead of relying on motivation, you've created a habit that runs in the background. And once that's in place, you're already solved. One of the hardest parts was is actually getting started and sticking with it. But there's another layer that makes this even easier, when is understanding risk in a practical way, because risk in investing isn't just about losing money, it's about how likely your money is to grow over time versus sitting still. And keeping everything in cash might feel safe, but inflation slowly erodes its value, meaning you're actually losing purchasing power without realizing it. So investing becomes less about taking wild risk and more about choosing the right level of exposure for your timeline. And this is why younger investors can afford to take or more market exposure, because they have time to recover from the downturns, while someone closer to needing their money, they might shift towards more stable options. But even this diversification spreads that risk across different areas. So one downturn doesn't wipe you out. And this is where simple portfolios shine, because they balance growth and stability without the constant micromanagement. And once you realize you don't need to check your investments every day or react to every headline, it removes huge amount of stress and decision fatigue, because the market will always move up and down in the short term, but historically trends upward in the long term. Then reacting emotionally to those movements is one of the fastest way to lose money. So simplifying your approach actually protects you from your own impulses. And that's something most beginners don't expect, because they think that doing more equals better results, when often the opposite is true. And the more you tinker, trade, and chase trends, the more likely you are to underperform. which is why a simple strategy held consistently often beats a complicated one executed poorly. And this is also where fees come into play because high fees quietly eat into your returns over time. And since investing is already about letting growth compound, reducing unnecessary costs gives you a direct advantage without taking an extra risk. This is why low cost funds are such a powerful tool. And once you combine the low fees, broad diversification, and consistent contributions, you've essentially built a system that works whether you're paying attention or not. And that's the goal because investing should fit into your life, not consume it. And another misconception, too, that trips people up is the idea that you need perfect timing to start, like waiting for the market to drop or for the right moment. But the reality is, no one consistently predicts short term movement. So waiting often just means missing out on time in the market, which is, again, is the most valuable factor. And a simple way around this is a dollar cost averaging, where you invest a fixed amount at regular intervals, regardless of the market conditions, which smooths out your entry point and removes the pressure of timing altogether. And this strategy works especially well for beginners because it turns investing into a routine rather than a high stakes decision. And if once you've built that routine, that process becomes automatic. And at that point, the biggest factor left is patience because wealth through investing doesn't happen overnight, but it does happen reliably over time if you stick to the fundamentals. And this is where mindset matters just as much as strategy because you need to accept that there will be downturns. There will be moments where your portfolio drops. And that's not a failure of the system, but a normal part of how markets function. And those downturns are often when consistent investors benefit the most because they're buying at lower prices while others panic and sell. And this is why keeping things simple helps you stay the course because complexity often leads to second guessing, and second guessing leads to bad decisions. And if you zoom out and look at the big picture, investing is really just a process of gradually converting earned income into assets that grow over time. And the sooner you start that process, the more powerful it becomes. And even if you feel late, you're still earlier than you think because the hardest step is just beginning. And once you take that step, everything else becomes easier through repetition and familiarity. And over time, what once felt confusing becomes second nature. And what once felt risky starts to feel normal. And that shift is where most people finally realize that investing is an elite skill reserved for a few, but a basic financial tool that anyone can use. And the real difference between people who build wealth and those who don't often come down to whether they started and stayed consistent, not whether they were smart or had better information. And that should be encouraging because it means the barrier to entry is much lower than it appears. And if you strip everything down to the essential, it really comes down to a few simple steps, which are earning income, saving a portion of it, investing that portion in diversified low cost assets, and repeating the process over time without getting distracted by noise. And while that might not sound exciting, it's incredibly effective. And effectiveness is what matters, not excitement, because the goal isn't to be entertained by your investment, but to let them quietly build your future in the background. And once you understand that, investing stops feeling like a complicated game and starts feeling like a system you can rely on. And that's when truly becomes easy, not because the market changes, but because your approach becomes clearer, simple, and sustainable over the long run and the long term, which is exactly what actually works. Thanks for watching today's video. If you found value in today's video, please subscribe. Without you subscribing, I can't build this channel any further, and YouTube says I gotta have a bunch of subscriptions. So I would love to see you subscribe. If you would do that for me, I'd highly appreciate it. Also, comment down below. I love talking to people, even if it's positive. If it's to tear me down, don't even bother. Go tear yourself down. Have a good day today. Oh, check out this video to the right. It could also help you on your journey as well. We'll talk to you guys tomorrow. Have a good day.